Okay, in this video clip, we're going to explore a bit some off-the-shelf machine learning models, and we're going to apply the sklearn libraries to estimating American options. And this is a data science approach to estimating American options, which are different, of course, from European options, which we typically estimate using Black-Scholes model. And if you want to explore a little bit what are the differences between American and European options? These YouTube clips that I've left here are not a bad place to start. So if you just go in here to, if we go in here to the estimation, so in the video clip here, we have, there's two video clips in fact, but I explain what are the differences for American options to relative to European options for different parameter inputs. So if you know nothing about European and American options, this is not a bad starting point. You might note here I used Leisenreimer and Black-Scholes. Black-Scholes for estimating the European option, and Leisenreimer, which is a lattice technique very similar to Cox Ross Rubinstein, and yields approximately the same values, but same idea and similar type of implementation. I used Leisenreimer here for valuing the American option. But some of the differences then in terms of the valuation, I explore how the European option can differ from the American option, and under what circumstances could a divergence in the valuations occur, right? So this is for a put here. We have the European put and the American put valuations, time value parabolas for different stock prices, different exercises. This is the intrinsic value of the call, again, this is European option and its intrinsic value, and the American option parabola with its intrinsic value. So that's worth exploring a little bit. But what I'm trying to do here in this instance is tackle the problem coming from a slightly different approach, and basically to see if we can build models using sklearn, using linear regression, random forest, and XGBoost to determine how well machine learning can be applied to the valuation of American options, and also just to scope out a little bit the level of error. So, okay, so we have stock price, maturity of the option, risk-free rate, cost of carry, dividend yield, volatility. The American options are valued at 15,000 steps using Cox Ross Rubinstein tree. Some explanation, you can go to the video clips here to get some kind of context and background. We'll have strong, weak options, categorizations. We're going to work with weak options, and we're not going to use strong in this instance. And the data set that we use is a data set that I took from previous research from Shang and Byrne 2000. In fact, it's the other paper, it's the Journal of Futures market paper. And we took some data from that paper to scope out, if you like, for different parameter inputs, put call designations. We obtained the true value of the American option and its European analog. And then all the options that we selected out of that data set were the weak ones, right? And we'll talk about that in a moment. Okay, so first thing we need to do is to import in our libraries. Now, there's some other links there worth exploring. I won't delve in too deeply now. We need to import the usual sklearn. Well, in this instance, it's pandas, numpy, matplotlib, seaborn for graphing. So it's mainly the graphing visualization, and pandas for data manipulation, numpy for mathematical operations. And as always, when we're implementing some data paradigm, we have to introduce data. So the data is not automatically sitting here. I've got to bring it in. The PWD just tells us where the working directory is. It's in the content folder. Where is the content folder? You can just come over here and just look for a content folder. When we open up, there's no data, relevant data here. There is sample data that's always there from Google Colab, right? And we're going to use the Jupyter Notebook here in this Google Colab for all our estimation. But we don't have data pertinent to the options here. To obtain the data, and again, the data, just to note, comes from this paper here, the American Option Pricing, Optimal Lattice Models and Multidimensional Efficiency Tests, and that was published in 2020, December 2020. So the data that we used here, we had, I think, 3,000 options, and we have removed the strong options, okay? And okay, so let's just check what's in our data set. But to get our data, follow the link. So I have the data set up in a Google Drive. You can download that CSV file, right? So it'll go into, in this instance, my downloads. And then to read it in, we can come over to the content folder and say, upload that data. And then we look, it's just sitting there in our downloads, right? Option price data. It's a CSV file. Let's just open it. And while this project is running, this Python notebook is running, that data is there. But as soon as we close, the data is gone. So when you start or open up this notebook, which I'll leave in a link below the video clip where you can find the Google Colab, you'll have to enter the data again, right? Okay, so the data is now sitting there. We can take a look, just double click just to see what's in there. Can take a look at the CSV file. So we've SKTRBV, whether the options put or call, AmericanTrue, so that's at 15,000 steps, Cox Ross Rubinstein tree. So we've estimated, taking these parameters, and we use a 15,000 step tree, Cox Ross Rubinstein tree to estimate. Let's go again. So where did that go? Okay, so we reconnected. I think we lost the link for a second to the server. It's back on. So 15,000 step tree produces these relatively precise, reasonably quite accurate. In fact, in the literature, 15,000 step Cox Ross Rubinstein tree yields true. That's a kind of a threshold that's commonly accepted in the literature. Sometimes 10,000 step tree. Okay, so that's what our data set looks like in the CSV viewer there. Now we want to then bring our data in. So we'll use this pandas command to read in this option price data, the CSV file, and we're going to call it df. And then df.head would give us the first 10 observations here, the first 10 rows of our data set. And we have AmericanTrue. Now, a little bit here, American value at 15,000 steps for Cox Ross Rubinstein. And to note also here that thus we can, in abstract, say true value if Black-Scholes 1973, Black-Scholes assumptions are met, and Brody and Temple 1996 obtained the true value of American options by elaborating 15,000 step benchmark binomial model for Cox Ross Rubinstein. And Amin and Khan in 1994 proved that discrete time models converge to the corresponding continuous time models, right? So 15,000 steps is a reasonable proxy for true. That's just basically. So this is our data set. What we want to predict, the dependent variable here, or the target variable, is going to be AmericanTrue. And we're going to use all the other parameters and European values, so the Black-Scholes value for the option. And all our options are weak, right? So we've excluded the strong options, which tend to produce a higher level of error. Also to note, 15,000 steps is not easy to do. If you have a static approach in your modeling, that can take as long as 18 minutes for each of these Cox Ross Rubinstein trees to execute. We use a technique that we developed called intelligent lattice search. If you want to see the link to that and how you could set up in a spreadsheet intelligent lattice search, I've left the code here, and there's explanation as well from Quinn Rue outlining how you can implement that approach, right? So that's there if you need to take a deeper dive. Okay, so the data set then are weak options from Shang Byrne 2020. With the link here to the Journal of Futures Markets, and we generated this data, the parameters using Monte Carlo protocols. The stock price is distributed uniformly between 70 and 30. So you can see the stock prices don't go beyond 70 and 130, beyond 70, below 70 or higher than 130. And then the exercise price here is fixed at 100. And time to maturity T is also uniformly randomized with boundaries between 0.1 and 1 years with a probability weight of 0.75, and additionally 1 to 5 years with a probability of 0.25. So we've sort of set out values that are more typical, and we've weighted them in such a manner that we randomly generate, but we give higher weighting to certain maturities, right? And a lower weighting where normally for the longer dated instruments that 1 to 5 years, they're less common, but of course do exist, and there's leaps as well. The risk-free rate is bounded between 0 and 0.1 with probability of 0.8 and equal to 0 with a probability of 0.2. So 20% of the time, the risk-free rate is 20%, but the rest of the time, it's between 0.1, 0 and 0.1, which would be 10% risk-free rate, which is quite a high risk-free rate. The dividend yield Q is uniformly generated spanning 0 to 0.1. The volatility range between 0.1 and 0.6 and adheres to a uniform distribution. The strike price is fixed at 100. The options are configured with a 0.5 probability of being a call or a put. So basically the data that we have in here is generated with Monte Carlo, and in some instances the distribution is uniform but bounded, and we put different weightings on different type of outcomes. So we've rigged it a little bit, but those values also are kind of typical. So the rigging is meant to characterize a relatively real type situation. And we want to explore, with this data set, we want to explore a little bit what's going on. Okay, we have puts here for the tail. So the final 10 you can see in the data set, there's 2,280 rows of data with American values, European values, and the options for both puts and calls. Okay, is there any missing data here? None. Okay, and can we describe the data? Give some descriptive statistics. Again, you can see no empty cells, so all populated, and we can take the mean value. Now, because the stock price is uniformly distributed between 70 and 130, we get a value here of the mean of 151. That's perfectly fine. We don't have a huge data set. It's 2,281 rows. So if we had a bigger data set, this would converge to 100 or closer. The mean value for the stock would converge closer to 100. Okay, the mean value for T is 1 year. Standard deviation is 1.23. The risk-free rate, the mean is 0.4. B is, so that's the difference between risk-free rate, and the dividend is likely negative, almost 0. The volatility is mean value is 36. That's, well, it's quite high, but not out of line with maybe where the VIX has been in recent years. And then we have valuations, the mean value, the options, and so on. All our options were weak. Now, we don't have to execute this because we don't have any empty columns. So we had before some additional columns, and I was able to just drop them out using that command, but doesn't apply in this case. I can transpose that data set, those descriptive statistics, just by adding in transpose, open, close brackets. We can sort the data from the highest price to the lowest. So you can see the stock price went from 70 up to 129. So that's consistent with the boundaries of 70 to 130. That's fine. We reverse that, so it's the same. And we can look at the tail value of that. So I think that's fine. We can print then to see what's in our data sets. I don't think there's any major issues with it. We have all our options are weak, right? All our options are weak. And anything else, we have slightly more puts than calls, right? We have 1,205. So basically, even though we modeled it as 50-50, because we excluded the strong options, calls typically, they're unbounded. Put values are bounded. So more call options were excluded when we excluded the strong options. And again, maybe to understand what the strong options are, find at the moment, the strong options, Gaudenzi and Presacco 2003 and Presacco al. 2008 found that accuracy of American option pricing is linked to strong, weak underlying conditions of parameters. Strong options, while few relative all options contribute proportionally to the largest part of the estimation error. Presacco al. 2008 chose an AER, so American to European ratio of 1.4 to filter options in terms of being strong. So we get this idea that the American options can be very significant, can be bigger, greater than European analogs. And when we exceed the ratio of 1.4, then we have strong American options, and pricing there is a little bit more difficult. So we've excluded from our data set here the strong options. And that's just purely for convenience, right? When we look at, now I should probably run through just graphing a little bit, the stock price. You can see we're bounded between 70 and 130. It is relatively uniform. The cost of carry, we go from -10 to +10%. That's as we would have expected. It's not a uniform distribution. We put a lot of weighting on R being 0, if you recall. So we said the risk-free rate R is bounded between 0 and 0.1 with a probability of 0.8 and equal to 0 with a probability of 0.2. The dividend yield Q is uniformly generated spanning 0 to 0.1. Okay, so that accounts then, that gives us some idea of the type of distribution we've generated using Monte Carlo techniques. Only weak options were selected. So, you know, there was only one category of option. There was no strong, only weak, right? When we look at the American options and the European options, so when we look at the American values for all the options and compare the puts to the calls, we find that very similar. The median values, the percentiles line up very close. And the percentiles here are just a little bit higher in the call option. And that's because call options typically are unbounded. The put option valuation is the maximum value is the difference between the exercise and the stock price. And S can only, the value of the stock can only fall to 0. And it's bounded by 0, where on the upside, there's no boundary on the upside to the stock price. So some of the call options are going to have higher values than than the put option. So we're going to get a little bit of more outliers here. And same for the European put options as well. Okay, when we put them into, when we map out the distribution using box plots, right, we're getting outliers. So the we're exceeding the interquartile 1.5 times the interquartile range, and these values are really the outliers. But we have more outliers for calls than for puts, and yes, that would be expected given this data set. What about the maturity? We've kind of loaded the maturity, so the bulk of the time the maturity is less than 1 year, but we do run some values where it's kind of a uniform distribution then between 1 and 5 years. So there's some maturities between 1 and 5, but the bulk are between 0 and 1. Okay, and you can follow that there. And then the number of options, when we exclude, so it was a 50-50 divide, but we excluded the strong options and more calls fell out as a result. So we've slightly, in this particular data set, which is composed entirely of weak options, some of the calls, more calls have been excluded than puts. And again, if you want to get a sense of why the American option is greater than European and under what circumstances, those 2 video clips there should fill the gap. So I encourage people to take a look there if you're kind of new to, if you have more just basic understanding what an American and European options are, then maybe to fill in some of the gaps, I think those 2 clips might help. In the estimation here, I use Lattice and Reimer as opposed to Cox Ross Rubinstein. When we compare the values of the European options to American options, you can see there is kind of, for the lower values, so for out of the money options, typically the values are not that different. For in the money options, the values, you can see the difference between the European and American tends to increase, right? So for out of the money options, European and American options would align closely enough, but then as we get to in the money options, you can see there's a sort of a widening out again. And we excluded the strong options, so probably we're missing some of that error that could be there. And then the cost to carry, again, we had said that the R could go between 0 and 10%, and we put some weightings on that. So that is the distribution of the cost to carry. And next thing, just do maybe a correlation, just matrix, and that might be useful to summarize some of the patterns we observe. The European and American options are highly correlated. It's 1. So they tend to move in the same direction nearly all the time. And the higher T is, the higher the European and American options. So longer maturities tend to reflect, tend to be associated with higher values being attributed to both European and American options. Now, there's some exceptions. Sometimes when you raise T, it can reduce the value of the European option. But I won't explore that too deeply here. What else? The volatile R is, of course, there's a high correlation between R and B, and B and R. And then also volatility. As we increase volatility, the value of the American option and European option tends to go up also. Okay, so those are things that are quite striking. Also, perhaps we can see here that as we increase T, AER tends to increase. When we increase T, the European and American options tends to increase as well. Okay, so they're interesting in their own rights. Why doesn't R appear here? Well, R was fixed at 100, so we can't compare any variation because there's no variation in K, the exercise, relative to anything else. We can drop the weak options column because it has no bearing. they were all weak. So we don't want to include that. And for purposes of running the machine learning, we've got to convert the put call into a dummy, and it now becomes a 1-0. And if we eyeball our data, so our attributes now, we've created 2 new columns, or 1 new column, if you like, or we've converted an existing column into 2 new columns, and it now pops up as a dummy. So if it's a put, we have here, you can see 1, right? Again, if we go back, they were P for the head. They were mainly P, if I recall. The puts, let's see. Yeah, if we come here, we can see P. Now what we've done is we've converted this into 2 columns and 1 or 0, denoting whether it's a call or a put. Okay, so we needed to do that to run our estimation here. Okay, so now we're on to the modeling bit. Now we took a look at our data after making those changes. We now have a dummy. I could write that data out if I wanted to eyeball it, and you can see if we come over to the content folder here, that would be posted in. So we've created this data set that I've altered a bit. If I want to take a look, I can double click here, take a look, or I can download, right? If I want to download the data, it's possible to download and eyeball it. What do I want to predict in my data set? I want to predict the American option using everything else. So I create an X and a Y, and this is a typical approach set out using the SK libraries. And I'm going to drop the American option. So everything else is X. They're the attributes, and I want to predict Y. Y is the American true value based on the 15,000 steps Cox Ross Rubinstein. Then I have sklearn library. So I do that split, which is pre-built in command that very nicely can split up my data set into a training data set and to a testing data set. So we had 2,281 observations, I think. And we're going to split that into training and testing, with 30% going into the test data set and the 70% going into the training. So we set aside the 30% of the data for testing, and initially we're going to run ordinary least squares on the training data set. That's 70% of the data set, create a model called LMFit, and then use that model to predict from our training data set initially, right? So we've introduced using sklearn. So it's an off-the-shelf machine learning package, right? And we're going to use linear regression as the first technique for modeling the American option price. And then from the model, we're going to predict the price of the option, the American option. So using the training data, we will predict, and then we'll assess that in terms of its R-squared and MSE and root mean squared error and so on. And what we find here is we have a very high R-squared, which looks very promising, at least at first glance. And we can do some visualization here. We can compare. This is typically what you would do in a linear modeling type setup. We would compare the actual against the predicted, the model fit against true, if you like. And there seems to be quite reasonable aligning, but there is some error, and it's both here and here. What the source of that error is. Now we can take the difference between the prediction and true. So the Y train, the predicted value, and the Y train. We can take the difference, if you like. So this is the predicted value here, and then this is the error. So the true actual minus the residual. So we get the residuals based on this term here, and compare against the predicted value from the models. we can see the error can be as much as $3, where the exercise is 100. That's the most egregious cases. By and large, probably not too bad, but there is significant error here. And a $3 being out $3 when you're trying to price an option, when we know the true value, that level of error is quite high, right? So as much as we're getting an R squared of 99%, in fact 99.79%, which is really, really good in any empirical type of environment, for predicting American options, that level of error is falling short a bit. So it's a bit disappointing in that sense, right? So this is one of the things we probably got to recognize, that even though we can achieve high levels of accuracy in terms of traditional, R squares and so on, probably wouldn't be, the level of precision here wouldn't be good enough. Okay, so I suppose this scopes out a little bit the level of error we're typically going to get with machine learning models when we apply a machine learning paradigm here for this American option pricing, where the values we're trying to predict are the theoretical true values. You can see we're falling short. Now, this approach, the machine learning, could still be very useful in predicting market values because there's a lot of noise anyway. But in this instance, this looks as if it's falling a bit short. Maybe we do better with random forest. Now, in a typical approach, once you've estimated your model using the training data set, then you use the X-test, the testing data, the 30% that you left over, and just to see, does your R squared hold up? And it's still performing incredibly in terms of an R squared of 99.74%. That's almost 1. And empirically, that's just something you'd be very happy with. Typically, we could do that with, we could do a cross-validation here with this data set just to see what we're getting. Now, this is with the training data, and we're scoring, with the cross-validation, you typically, again, have your training and testing data. But in this instance, we do 5 folds and we leave out, we run the training model and we exclude 1/5 of the data, and we do that using this type of pattern. And then we evaluate the models, the 5 cross-validations. They're all 99.8, 99.6, 99.7. So very, very good. But again, when we look at the residual, there is quite a bit of error, right? So again, I'm going to move on here then to the random forest approach. Again, I'm going to follow exactly the same type of, we train the model using the training data. We estimate the R squared, it's really high, 9997, that's really great R squared. We look at the level of the actual price against the predicted price. It looks as if they line up very nicely. Check the residuals, then take the training data. So these are true minus the predicted, so that produces a residual value, if you like, here. And we compare that against the predicted. And again, we've less error than before, but we do still have some error, right? And this range of, $2 out on a $100 exercise it's quite substantial, right? So again, even though R squares are really good, when we look at the actual price of the option relative to true, we're falling short, right? And we can do cross-validation again using the random forest, and you're typically scoring, in that range, the 999 range, right? Which is, it's great. And in any empirical type modeling, in any empirical type where you're trying to predict a market price, this would be really good, but we're predicting a theoretical price. And the model hasn't really learned, if you like, the intricacies and the nonlinearities associated with American option pricing. XG Boost is another approach. We'll just try it here. We'll implement and we'll just go through and we can assess all the models. So we do a training and testing. We're getting very nice R squares, and we can estimate the predicted value using the test data and examine the R squares for that. Still very, very good. I won't do the cross-validation here on XG Boost. Comparing the three models, then what do we get for linear regression, random forest, XG Boost? We're getting XG Boost is marginally better than random forest, which in turn is marginally better than linear regression. Now, removing error here at all in that range is a big improvement, right? And we might even see that, but this is, so it looks very good, looks very promising, but here's where it's probably important to give a health warning. If we predict using the test data and the XG Boost, you can see these are the predicted values, 2691, 204 for the true value of the American option, right? And I can come down here perhaps and say, okay, let's take, for instance, the test data and just look at what we've put in, just the first 12 rows, and we're getting 2688. Sorry, so this is for the European option, right? And so this is the data set we would be using, the first 12 rows of the data set in the test data, right? And we can predict the first, what we have, 12 rows here, right? So we can take the American valuation, right? Okay, so I'll just recap here. What we have here in the Y test head is remember we're trying to predict the AmericanTrue, and this is the first 12 observations, right, in that data set. So we have 2,200, I think, and 81 all in, but we'll just take for the entire data set, and then we split along the 70% and the 30% lines. But here we have just the first 12 rows of what? Of AmericanTrue. So it's the Y test data. This is what we're trying to predict, and these are the true values of the American option. Okay, we take the XG Boost model and we predict, and we refer to the model as REG. So this is the XG Boost model that we estimated, and we take the other data, right? We take this data, the X test data. So this is what we've been using to model. This is the attributes, and we're using this to predict the American option. So we have the stock price, the exercise, the maturity, the risk-free rate, the cost of carry, the volatility, the Black-Scholes model, the AER, and whether it's a call or put. And we're using this XG Boost model, and we take the first 12 rows here, and we predict using the XG Boost model what the value of the option is. And this is what we get out. So the model is predicting 2691. Now let's just compare. And remember, XG Boost is yielding what? It's yielding an R squared of 99.89%. So that's really good, right? That's really good. Okay, and when we compare the true values against the predicted values using XG Boost, you can kind of get a sense of the scale of the error. 2688, that's true, but what we're getting from our XG Boost model is 2691. And then the next option, the true value is 2.06, but what we're getting from the model is 2.04. And from the next option, 571, which is the true value, but the model XG Boost with the 99% level of accuracy, 567. All the time it seems to be out by a fair amount. It's not awful, all the time. But it's never quite, you can see the extent. When you eyeball it like this, you can see that the model is falling short. So even though we're getting really high R squares, this sort of indicates a little bit the scale of the problem that we're dealing with, right? And of course, we can predict, we can maybe take a look at this and take a look at the residuals here that we're typically getting. And you can be out by as much as $3, negative $2, right? So you can look at the normality, but that gives a sense of the error. So a lot of the time it's doing okay, it's doing fine, but then we're getting these outliers as well that are fairly significant. And with an off-the-shelf machine learning model, perhaps this is very good, but it also suggests the scale of the problem, that machine learning techniques, when applied to option valuation, are going to come with some limitations. It's worth pointing out what the likely scale of that error is. It's not awful, and in many contexts, this would be a really good model. But we have quite reasonable techniques already for pricing American options. Okay, and Cox Ross Rubinstein model or Lyson-Limer model is probably the most sensible approach. If you're dealing with something that you didn't have a model for at all, maybe this machine learning approach then starts to add value. And then if we have market values, which is a separate area really, if we have market values for the option, then an empirical approach using machine learning techniques, I think that probably could work reasonably well. If we were estimating the implied volatility surface, I think machine learning models would be very credible. But maybe we haven't looked under every stone here, and obviously we could explore more using TensorFlow, maybe exploring more aggressively neural networks. Maybe we could use the phrase that's commonly used in machine learning, boil a little bit of that sea to see what comes up. But even when you're getting this very high level of accuracy, right, which we've obtained in terms of our R squared, we're still a bit falling short in terms of a model that is giving us reasonable theoretical value. So it's not completely appropriate probably to use these machine learning techniques to predict maybe a theoretical value, a theoretically true value for the option. But for market values, I think, of course, 99% level of accuracy, that would be that is something that we would be very happy with, I would say generally. Okay, so basically what I've tried to do here is just to set out how machine learning might be applied in a very basic way. And obviously there's a lot of scope here to do other things, to apply maybe better rendered machine learning techniques. And what I didn't touch, of course, is the neural networks, and they offer additional potential. And maybe if we used a bigger data set, we only had 2,000 whatever 200 rows of data, but perhaps if we had increased to 50,000 or 100,000 or to 1 million rows of data, then we would have produced higher levels of accuracy for training and testing. Okay, I'll leave this video here.